How you doing? How's it going?
Big day. Big day.
Hey, Zach, out of the chute, man. You need to spend some money and get a microphone stand that you broke.
Listen, I've got a microphone stand. Every time I set it up, and it's funny because I was in another Airbnb right next door. They have the same table in here. And every time I was hooking it up, I was like scratching their table. And this is not my table. So I don't know what to do. I got to get a, I don't know.
Spend a few dollars.
Man, I'm out here reporting. If somebody walks in, I could, hand them the mic.
Somebody walks into your kitchen. Here you go.
Crypto on the street.
All right. Well, we're really professional here. Jonathan, how are you, sir? It's good to see you, man.
Doing great. It's a beautiful day, and thank you so much for having me today, fellas.
You're welcome, man. You're welcome. So we're going to hang out here for a while. We've got a lot to talk about. We got the FOMC Federal Reserve meeting, or the meeting's going to go live in about 28 minutes. We're going to check in on it. We're going to look at Bloomberg. We're going to do a lot of stuff. We're going to have overall conversation. We're going to talk about Shiba Inu. We're probably going to talk about Zach and his microphone. We're going to talk about, oh, by the way, notice how Zach's got those tan lines on the side of his face?
Dude, come on now. I know. The problem is you cannot, or at least I can. I cannot stay outside and just be squinting the whole time. So I got to wear my shades, and then there you go. But you can tell I've been out in the sun.
Because you don't have any hair, dude. That's it.
Period. I know.
Okay.
Cleaned it up.
He cleaned it up. Cleaned it up. So, Jonathan, I'm going to throw you right immediately into it. We got people already asking in the comments about Shibarium. You are the guy, in my opinion, when it comes to Shibarium, gas, fees, tokens, Shiba Inu. So talk to us about your opinion on Shibarium. So go.
Well, I'm even more excited right now, fellas. Satoshi is playing this little game with everybody, and we've kind of felt the game go back and forth. But this email that he sent out from the blog today, the test email, it's kind of letting everyone know, hey, you better, like you said, get your popcorn ready, because the next one's the big one. And I'm looking, like you've said, in that heart-shaped box on the 14th. I'm looking like go time. Trust me, my bag for Bone is overflowing. And I put out a video this morning about giving you a heads up. That's all I've ever done as a YouTuber, is try to give people a heads up. And we've given you a heads up. If you are not involved in Bone or Shib and Leash, I think you're going to miss it. Just miss it. Now, I don't tell people what to buy, but this is a heads up.
Yeah. I mean, Zach, what's your 2 cents on that?
Yeah, man. I mean, so Austin and I just recorded some videos together about this kind of leak. I guess you could say that it was. Maybe it was a purposeful leak or not, or whatever, right? But it's the backbone, man. Shibarium is the backbone, and yes, it's an L2, but in reality, I look at it as their own blockchain, right? And anybody who has their own blockchain in this space is in a different category, right? Ethereum doesn't rely on other blockchains; they have their own, right? And you could say that for all the top layer ones. Yes, this isn't a layer one, but they're going to be able to do things that they cannot do simply just because they have to rely on Ethereum right now, right? So we mentioned the gas wars that went on with the NFT drop, right? That's something that would be resolved. And they could just do things without the, having to get permission from Ethereum, if you will. So I'm looking forward to it. It's just the beginning. It's crazy that we're almost at 1.3 million holders now. And the largest utility hasn't even dropped yet. This is something that's going to bring us, I think, to the masses. And as you mentioned, Austin, in the video we did together a little bit, this really is going to allow Shib to bring in other ecosystems, right? Whether it's gaming, D-apps, or anything of the sort. So exciting.
Yeah. I wanted to get the exact number. So you brought it up. There's 1,292,000 and growing.
Close.
Yeah, so it's getting there. I think, I think you guys definitely, took the main points and made the point. By the way, for those of you guys who are joining in, we are going to be talking about the Fed, the Federal Reserve, the FOMC. They're going live in about 25 minutes. This will be Chairman Powell's speech, so we will cut to that here in a minute. We're also dropping on Bloomberg. Zach clued me in on this. Is really cool. We're going to drop in on Bloomberg's YouTube channel here in a minute, kind of see what they're saying. And after I make this comment, I'm going to go to each of you guys respectively and get you guys' opinion about what you guys think what we will see when we do see the speech, and then we'll open it up for Q&A and whatever. So I think Shibarium is, again, the backbone. I'm stealing that word from Zach. He coined that, and it's officially mine now. I think it's going to be the backbone, man, of the ecosystem. And And John, I got to give you credit. I own some bone, but man, the first time you started talking about it and I learned how much you had, I'm like, well, shit, I need to go buy some more damn bone. So I did. Nothing like what you have, but I think it's going to be a simple matter of, Bone's going to do really, 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 really well, and Shiba Inu as well. And so, like right here, somebody dropped in Freddie right there. So you think Bone can reach 230 in the month after February? I think heck yeah, if not higher. Jonathan, I'm going to defer to you. What's your opinion?
I believe 230 is way too low. We can hit 230 without anything happening right now, just off the chart. I believe between $5 to $8 the second that Shibarium is released, and then there's just going to be a fight for that total supply of 250 million. So there's no telling where Bone is going to go. And one last thing, there's 10,000. You have to have 10,000 Bone to be a validator. A lot of people don't know about that, but there's a lot of people stacking at least 10,000 Bone right now so they can be a validator on the network.
Well, there you go. That's actually a good point. I'm glad you brought that up. Let me make that go away so you don't cover your face up, dude. But I mean, their all-time high, right, for Bone, there you go, was approximately $3 and 24 cents. So I mean, yeah, I think it's doable to definitely surpass the $2+ range. And I tend to agree with you. Now, actually, Jonathan, let me ask you a question. I mean, because when it does launch, it's a test net launch, right? It's a beta test net. I mean, so do you? I think that's that real big spike. I think is it more in line with a mainnet launch, or do you think it's just going to launch? It's going to spike off of it's here. What's your what's your opinion there?
Here's the truth about it, everyone, and this is my opinion. When people see the first launch here, they're not going to know what they're looking at. They're not going to understand, okay? But then they're going to understand as they roll out the paperwork, how the back end works and how everything ties into it and the burns. And actually, oh, I do need gas fees to do this, or I do need Bone to do this. So once they understand it, it's going to astronomically move up. But once the people see the test net, they then know that all of the hype was real. And that's when the FOMO will start, in my opinion.
Okay, fair enough. Okay, so let's shift real quick before we kind of go cut to some Bloomberg and some stuff. So let's shift to the Federal Reserve FOMC. By the way, we got 800 plus people here live. Hit the subscribe button and hit the like button. You need to subscribe to be able to drop in the comments. Go ahead, Zach. What were you going to say?
No, I was going to say we're streaming on three different platforms too. So this is awesome. We're over on Clear Crypto's channel. We're on Austin's channel and my channel too. So welcome in everybody. This is awesome, and this is a big day for all of crypto. So
it's cool. So yeah, so it's interesting. So like we are dual streaming to my channel as cool. Well as Zach's channel. It's the first time. So Jonathan, we'll have to get you added into the mix soon so we can stream to you too. So here's Zach's channel. For those of you guys watching, if you're not familiar with Zach, there's Zach right there with, the bald headed dude right down there. Got to say it right.
Yeah, man.
Yeah, man.
And check out the constant growth. We're doing some cool things over here too, man.
There you go. So go check it out.
A ton of fun. It's our second channel. So talking about success, money, life, living better, living good, walking the beach, doing cool stuff. So come check us out.
Yeah. Still
I had to jab you with the beach the beach comment.
I was gonna give you a plug. Now I'm not gonna do that. Go unsubscribe. No, I'm kidding. I'm kidding. All right. So we're gonna give Zach a subscribe. Jonathan's here with us. Obviously, Jonathan is great influencer, trying to help him grow his channel as well. So definitely give him a subscribe there. He's at the One-Legged Bandit. So go subscribe to his channel as well. And so for doing shout outs, this is the channel I started with my wife. There's a link in the description below to this as well. So you can see my better half. So that's in the links in the description. All right. So
Poconos, beach life rules. Let's go, bro.
Yeah. If I could live there, I would. That's the point, dude. I'm in suburbia here. Okay. So let's take a look. So this is obviously what we're waiting on. Obviously, this will go live when Chairman Powell steps up to the podium.
Papa Powell.
Yep, Papa Powell. But we're on an ad here real quickly, but when this comes back, we'll maybe drop in on Bloomberg, kind of see what they've got going on. So let's cut to this and kind of see what they're saying, and then we'll go from there.
Yeah, no audio. Okay, so Austin, I think
Go ahead.
this might be the issue. So no sound. So okay, if I wonder if the only people getting sound are people on your live stream. I'm wondering.
Oh, okay. So this is the first time. Okay. So this is the first time we've done this where we're dual broadcasting to my channel and to Zach's channel. So those of you guys, so here's what we need to know. If you're on my channel, drop in the comments and tell me if you can hear it. If you're on Zach's channel, drop in the comments.
There's
Say,
a
I'm
lot
on
of no
Zach.
sound coming in. Yeah, a lot of no
Okay. I'm on
sound, no voice,
Austin's.
guys.
No audio. Okay. So we are having a problem with StreamYard. So guys, the broadcast system, the software we use is called StreamYard. So Zach ran into this where sometimes it doesn't pick up audio if you're playing a video. So that would seem to be the problem. Is that right, Zach?
And there's a setting that you can hit, Austin, on that screen. Try to hit that setting that says play sound or play audio on that screen.
On what screen?
The screen that's got CNBC or whatever channel this is right here. Bloomberg.
I got
it's muted.
No, it was. Now I'm playing it.
There should be down at the bottom on the settings, like where you see at the bottom in the green screen area. Click the little 3 dots and then click play sound on this video or this channel.
I'm telling you, talking about. So bear with us, guys. We're troubleshooting here. You talking about inside of StreamYard?
Yes, in the back screen area down at the bottom.
Audio. Sure. Speaker. Camera. General. Shift. Bear with me. You guys talk amongst yourself.
Well, yeah, we're gonna sort it out before we go live here. We're gonna do it one way or another here. So we might end up having to just play through a phone. I wonder if that would pick up, because if it comes through my mic or one of our mics, we should be able to have it come through 3 channels, I think.
Zach, pull up on your phone. Pull up that Bloomberg broadcast video on your phone, and then put it. And if it works, then I might do it on mine, because I can move my mic more easily. Or you could set your mic down, and they would be by your phone. So see if that'll
100%.
do it.
Yeah. So let me see if that works, and we'll see, because we want to get it right before we got about 15 minutes. So we'll sort it out here. Hold on. All right, guys. Let's see here. We're on a little ad here. All right, guys. Let us know what this sounds like here.
I think it's really important to understand that the data we've just gotten in the last couple of days actually hardens the Fed's resolve. And Chairman Powell went out of his way to say that there was no one who had a rate cut priced in December in the SEP
That works.
when he talked about it. Now, Chairman Powell doesn't really love the SEP. It's something that's been sort of a thorn in his side at times. But I think that was very important guidance that he gave, that no one had a rate cut for 2023. The Fed really wants to hammer that point in. And even though we have some doves on the Fed, they're going to be relooking at the data that's just come in and say, you know what? We should stick to where we are. Stay the course is what we heard over and over again. This is going to be a very hawkish description of that meeting. And I don't think there's as much debate as many people thought was emerging. I think that just got quelched by the data we've seen.
Mike Apen, your thoughts?
So I would agree. I don't think the SEP would have changed all that much. I think that the terminal rate projection.
Okay. So we are getting some audio there.
Yeah. So we're good
so
on that.
I can play it. I could play the actual meeting through there.
Yeah. And if you want, Zach, you take control of the screen when we go to the meeting. So thank you guys for hanging with us. We got that figured out. So here's what I want to talk about. So I want to go Zach, then you, Jonathan. So what do you guys think we're going to see? I think we all think we're going to see 25 basis points, right? So what do you guys think we're going to see today? Do you think Papa Powell is going to give us any indicators? Jonathan, Zach, go ahead. You go first, man.
Well, the overwhelming expectation is 25 basis points. And Austin, do you have that? Do you have that tweet? I can actually pull it up on mine either.
Yeah, you want me to pull it, or you got it?
Yeah, here, hold on, I got it. Let me share that. There we go. Can you just share my screen for me?
Yep, there you go.
So here we go. So this is a nice little preview, and I think this is kind of in line with what we'll probably see. So a 25 basis point hike is expected as a near certainty right now, with Fed funds futures pricing in a 2% chance of a 50 basis point surprise. If we did get that 50 basis point surprise, I do think the markets would tumble really quickly. And obviously, you could look at that one of two ways. One way is, oh my gosh, it's free falling. I got to get the heck out of here. I'm checking out for the day. Or sit there and wait and buy, because we do see the market come back.
Zach, sorry, just broke. They have announced 25 basis, so that is out.
25 basis point is live. Okay.
Yeah. So if we show you, so here you go. So Fed interest rate does go up 25 basis points. So there you go. Keep going, man. Go ahead.
And the overall crypto market's really not doing much with this. I mean, it's not official yet. Well, I guess it's official, but we haven't heard from Powell. Market's pretty flat, which, a lot of people thought it was going to be priced in, right? If 25 basis point came in, everybody was kind of, it could be a big nothing burger, because I think was everybody's expectation, right? But I think the real big thing here that we're watching for are all eyes are going to be on the ongoing increases, or hopefully lack thereof, ongoing increases. And I think that's where we all want to get some insight. I don't know if we will. Powell has a very interesting way of saying a lot of words, but saying absolutely nothing at all. And so we'll see if that's what happens.
Jonathan, go ahead, man.
I am extremely bullish. All right, everyone hearing my voice, this is exactly what the bulls wanted to hear. 2.5, we stay normal. We continue on our upward rise. We got 30 more days of good news, great progress. All these projects are going to start releasing more and more news. The bulls are in the house with this news, in my opinion. I am definitely a buyer today.
I like it.
Wow.
Some other things for the press conference, too. Watch for a hawkish message from Powell that December's terminal rate forecast is still accurate. So basically, everything that was said in December, hopefully that sort of trend is continuing, and, hopefully there's no curveballs there. So,
all right. So here's to add on to that. So here's what the other side of this is. We have we got the 25 today. We were expecting that. There you go. They have a March meeting towards the end of March. I want to say, actually, let me pull up the exact dates. Hold on just a minute. I can show you the exact dates. So where was that? I had Googled it. There we go, right here. So here is the next board. Here's the next FOMC meeting. So we've got today, obviously. So we've got another FOMC meeting, March 21 through 22. Again, there's the day we care about. We've got it. And then we've got a May 2nd and 3rd meeting. And we got a June 13th, 14th meeting. Okay. So here's why I'm showing that. So what people are going to want to hear from Powell today, and I agree, Zach, he's not going to answer it, is what are you going to raise the rate in March? And what are you going to raise the rate in May? Because the Wall Street wants them to only do really one more raise. Let's call that the March raise. And they want them to be done by June. So that leaves the May meeting in question of whether or not they do or do not raise it in May. So the expectation is, though, it seems to be a consensus, is that they would be done raising the rates, period, by June. That's kind of the expectation that's out there.
Let me ask you guys something. So there's this narrative out there, and I keep seeing it, where it's like, a recession could be hitting later this year, and fears of a recession. Okay, we all know what a recession actually is. We've been in recession. How could it get worse from here if inflation data is showing that it's getting better since it peaked in June? Is there something that is a lagging indicator so much that we're going to see potentially what we saw in June of last year? We were at 9%. What am I missing something?
No, I think that. Go ahead, Jonathan. Go ahead.
I want to throw something in here. Look, I have a couple businesses here, and I work with businesses every day. Let me tell you something about business and money right now. People are spending $4,000 for wedding photos. People are shopping. People are partying. People are making money. This has been the best January I've ever had, ever. I'm telling you right now, business, economy, money is being made. I think we can pull ourselves up through this. I really do.
There you go.
I like it. I think, Go ahead.
Well, I think that I think the whole soft landing, hard landing, I'm not going to go down too far on that rabbit hole. That depends on what talking head you want to believe or not believe. I think they have to stop at some point or else they will push us into an official recession, whether or not we're there or not, and who, depending on how you want to quantify, blah, 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 blah. What it really comes down to is this: as long as the CPI reports and the jobs reports keep coming in line and showing that number is moving down, I think we're in good shape. And I think earlier when we dropped into Bloomberg, some of the people couldn't hear it. The bank, the head guy from B of A was talking about the fact that, you're now starting to see the effects from the mid-year raises last year are really now starting to kind of hit. So it is kind of a lagging into, if you will, right? All the stuff we did 6, 7, 8 months ago is now starting to kind of really, get into effect again,
Yep, 100%. I mean, something else to consider here too, Austin, if you could help, you could share this real quick. So this is the US dollar currency index, okay? The DXY. So usually why we care about this, when the DXY is going down, usually crypto is going up and Bitcoin is going up. So you could see kind of where the reversal point was. Back in September, we peaked out with the DXY. Since then, we had a couple little rallies here, but really starting in November, it started to come down, and really here again to start January. So it makes sense that we're seeing Bitcoin. Usually these are inverse of each other, right? As one goes up, the other goes down, and vice versa. So this is good because why? Bitcoin's a hedge against the dollar, right? It's a hedge against inflation. So this is something else to consider here. We've been kind of trading sideways here. It hasn't been falling as much. We'll see kind of what happens after today. And so we'll be tracking this closely too. But crypto-wise, not a lot going on. I mean, this is kind of where we were before we came on, right? Pretty much.
No, it's gone down. We were down 1.2%. So we've shaved almost half of that.
So it's come up.
Yes.
Yeah, it's come up. It's gone in the right direction.
Okay. Yeah, I guess. Okay, so in the last hour, we've got a few up a little bit. I mean, nothing crazy. But yeah, I mean, we'll see if maybe Jay Powell gives us something to write home about here and maybe
Come
even
on,
rattle a little bit.
Zach, you and I've covered this. He is not going to say a damn thing.
And to be honest, fellas, one thing we definitely need to do, we don't need to stop raising interest rates yet. We can all see, even though we're all doing well, we're learning how to manage it. But but inflation is definitely a real thing. I mean, when you're paying $8 for a carton of eggs, we can see it. So I hope that they keep raising the rates and don't stop, because if they do stop, that is where our real trouble, our real pitfall could come into play. That's where we could all get ruined if they start this recession much quicker by pulling it, by letting everyone think that they're okay, but we're really not. You know what I mean?
Right. Mm-hmm. Right. So Zach, let's shift over and use your microphone. Let's go watch the. In fact, if you want to just go over to the Bloomberg.
Let's see if Bloomberg will play. Okay, so we're going to test this because we still have about 5-6 minutes. So we're going to test this real quick. We'll see if Bloomberg plays through here, through the laptop. I'm not quite sure. Maybe it's a laptop issue. If not, no worries. I've got my phone with me. We could play that, but we'll try this first. Let me mute. Okay, that's muted. That's good. All right, we'll try this first. And guys, give us something in chat. No worries if not. We'll play it through the phone if we need to. But here we go.
I can't hear it. No, I can't even hear it. No. Zach, can you hear me? No.
Okay, so all right, so that's a nothing burger. All right, no worries. We got it on the phone. So we're going to be listening to a lot audio. I'll time up the video with the audio on my phone because I love you out there. I love everybody out there. And we'll figure it out. Okay. All right. So let's see here. Here we go.
Man, we're high tech here.
Though, in this regard, you got
to be ready to pivot.
Hawkish in what you do. You can be hawkish in what you say. After slowing down for the second straight meeting to 25 basis points, it's going to be really hard to change the effect of that, right? So if they really, really wanted to push back against expectations of easing in financial conditions or cuts later, or just if they wanted to kind of, reassert their intent, they could have gone 50 and they didn't. So there's not a lot, I think, that you can talk about at this point without another forecast, to really kind of change what markets think. Markets know you slowed down again. So it's a dovish meeting on net relative to where the committee was just a month or two ago.
If it's a dovish meeting, Michael, and it was nice of you to arrange for CPI Wednesday or whatever it is to be Valentine's Day. Did you know that, John?
I didn't know that.
CPI is Valentine's Day. Michael Gapin, what if we get a disinflationary tinged February 14th CPI day? What does that do to our world?
Well, it reinforces the view that we're past peak inflation. It probably means it's easier for the Fed to accept that inflation's moving lower. And it would reinforce the
play
view
the video, show the video
that the Fed could be cutting later this year. So the faster inflation dissipates, then the Fed's at risk of its policy rate getting too tight, right? So there's some probability that you'll get cuts later this year. So I think it would reinforce the narrative.
Dan, you have an understanding of the Midwest of this nation like really no one we speak to. And I want to go to the great Jim Glassman at JP Morgan, who is heated in his commercial banking meetings of the optimism of America. I looked at a zip code in Kansas a couple days ago on a Blackstone thing, and the unemployment rate is 2.2% in Kansas. Is the East Coast, the elites like Lisa Abramowitz overwrought about all this while America booms?
All right, so what I want to do is try to time it up for the FOMC. It's hard to time up the video and the audio because, guys, we're streaming on 3 different channels here, so it's kind of weird hooking in the audio, but I think we found a way to do it, so we're going to have it all squared away here. FOMC meeting starts in 2 minutes, so what I'm going to do is try to time it up for that. And it might take me a little bit of a tweak here or there, but we'll have it ready.
And guys, it may not be perfect. We're having it. So for those of you guys who's just dropping in, we're having a little bit of a tech issue. If we play a video, it's not playing the audio for some of you guys. We are broadcasting on my channel, Zach's channel, and on Clear Crypto's channel. So
and
here's
Twitter
what
accounts.
Yeah. Here's what
Roberto said Zach's on Bumble.
Zach's on Bumble. Nice. I think he is.
Find me on Bumble.
Swipe left. I don't know.
Nice.
Whatever. So the federal, for those of you guys just dropping in, the Fed did raise the basis points, 25 basis points. Okay. We know that. And so we're waiting on Chairman Powell. His speech starts in literally 2 minutes. We all, Jonathan, Zach, myself, we all kind of have the same opinion that he's not going to answer the question. He's going to be asked the questions different times. And what we're really focusing on here, guys, is the March meeting and the May meeting, the next FOMC meetings, as far as what are they going to do to raise the rate there or not? And he's going to, Chairman Powell is going to talk about, we got to rely on the data. We got to get the data. We have the next CPI data report coming out on February 14th. That's the one that everybody's going to be looking at. Is it going to be good or not, et cetera? Jonathan, you want to add anything to that?
February 14th is supposedly the day that Shibarium is going to be released. Remember, all these things are kind of building up. Look at the charts and look how everything's moving. That February the 14th day could be a major day.
Yeah, it's a big day. Zach, any comments on what I just said?
Sorry, I was getting the stuff prepped. Shibarium, right? No.
Just kind of the Papa Powell. What's he going to say? All that stuff. Yeah.
No, I think you're right. And I think people are agreeing with you in chat too. I mean, just he's gonna be very, very careful with his words. And it looks like we're getting ready to go here. So here we go. Let's see what happens here. Austin, if you want to share my screen. We don't have audio yet, so we're not missing anything just yet.
Thank you all for being here with us today. Please subscribe to all of our channels. We work really hard putting out this content. I know y'all probably think it's easy work. It's not. It's all day long, and we love you. So thank you very much for being here.
100%. We really appreciate everybody hanging out with us. This is really cool. So we're still waiting on Jay Powell. Here he comes, the man of the hour.
Good afternoon and welcome. My colleagues and I understand the hardship that high inflation is causing, and we are strongly committed to bringing inflation back down to our 2% goal. Over the past year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 25 basis points. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we are continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 1%. Recent indicators point to modest growth of spending and production this quarter. Consumer spending appears to be expanding at a subdued pace, in part reflecting tighter financial conditions over the past year. Activity in the housing sector continues to weaken, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 247,000 jobs per month over the last 3 months. Although the pace of job gains has slowed over the course of the past year and nominal wage growth has shown some signs of easing, the labor market continues to be out of balance. Labor demand substantially exceeds the supply of available workers, and the labor force participation rate has changed little from a year ago. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in December, total PCE prices rose 5.0%. Excluding the volatile food and energy categories, core PCE prices rose 4.4%. The inflation data received over the past 3 months show a welcome reduction in the monthly pace of increases. And while recent developments are encouraging, we will need substantially more evidence to be confident that inflation is on a sustained downward path. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that's not grounds for complacency. Although inflation has moderated recently, it remains too high. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 25 basis points, bringing the target range to 4.5% to 4.75%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.5 percentage points over the past year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We are seeing the effects of our policy actions on demand in the most interest-sensitive sectors of the economy, particularly housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, The committee decided to raise interest rates by 25 basis points today, continuing the step down from last year's rapid pace of increases. Shifting to a slower pace will better allow the committee to assess the economy's progress toward our goals as we determine the extent of future increases that will be required to attain a sufficiently restrictive stance. We will continue to make our decisions meeting by meeting, taking into account the totality of incoming data and their implications for the outlook for economic activity and inflation. We have been taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Chris.
Chris Rugaber, Associated Press. Thank you for doing this. As you know, financial conditions have loosened since the fall, with bond yields falling, which has also brought down mortgage rates, and the stock market posted a solid gain in January. Does that make your job of combating inflation harder? And could you see lifting rates higher than you otherwise would to offset the increase or to offset the easing of financial conditions?
So it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place in order to bring inflation down to 2%. And of course, financial conditions have tightened very significantly over the past year. I would say that our focus is not on short-term moves, but on sustained changes to broader financial conditions. And it is our judgment that we're not yet at a sufficiently restrictive policy stance, which is why we say that we expect ongoing hikes will be appropriate. Of course, many things affect financial conditions, not just our policy. And we will take into account overall financial conditions along with many other factors as we set policy.
Rachel.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. Over the last quarter, we've seen a deceleration in prices, in wages, and a fall in consumer spending, all while the unemployment rate has been able to stay at a historic low. Does this at all change your view of how much the unemployment rate would need to go up, if at all, to see inflation come down to the levels you're looking for?
So I would say it is a good thing that the disinflation that we have seen so far has not come at the expense of a weaker labor market. But I would also say that disinflationary process that you now see underway is really at an early stage. What you see is really in the goods sector, you see inflation now coming down because supply chains have been fixed. Demand is shifting back to services, and shortages have been abated. So you see that in the housing services sector. We expect inflation to continue moving up for a while, but then to come down, assuming that new leases continue to be lower. So in those two sectors, you've got a good story. The issue is that we have a large sector called non-housing service, core non-housing services, where we don't see disinflation yet. But I would say that so far, what we see is progress, but without any weakening in labor market conditions.
Has your expectation for where the unemployment rate might go changed since December?
You know, we're going to write down new forecasts at the March meeting, and we'll see at that time. I will say that it is gratifying to see the disinflationary process now getting underway, and we continue to get strong labor market data. But you know, we'll update those forecasts in March.
Neil.
Hi, Chair Powell. Neil Irwin with Axios. You and some of your colleagues have emphasized the possibility that job openings could come down and that would let some of the air out of the labor market without major job losses. We saw the opposite in the December JOLTS this morning, job openings actually rising. That also has coincided with slowdown in wage inflation. Do you believe that openings are an important indicator to be studying to understand where the labor market is and where wage inflation might be heading?
So you're right about the data, of course. What we've seen average hourly earnings and now the employment cost index abating a little bit, still off of their highs of 6 months ago and more, but still at levels that are fairly elevated. The job openings number has been quite volatile recently, and I did see that it moved back up this morning. I do think that it's probably an important indicator. The ratio, I guess, is back up to 1.9 job openings to unemployed people who are looking for work. So it's an indicator, but nonetheless, you're right. We do see wages moving down. If you look across the rest of the labor market, you still see very high payroll job creation, and quits are still at an elevated level. So by many indicators, the job market is still very strong.
Colby and then Howard.
Thank you. Colby Smith with the Financial Times. Given the economic data since the December meeting, is the trajectory for the Fed funds rate in the most recent SEP still the best guidepost for the policy path forward? Or does ongoing now mean more than 2 rate rises now?
So you're right. At the December meeting, we all wrote down our best estimates of what we thought the ultimate level would be. And that's obviously back in December. And the median for that was between 5 and 5.25%. At the March meeting, we're going to update those assessments. We did not update them today. We did, however, continue to say that we believe ongoing rate hikes will be appropriate to attain a sufficiently restrictive stance of policy to bring inflation back down to 2%. We think we've covered a lot of ground, and financial conditions have certainly tightened. And I would say, still think there's work to do there. We haven't made a decision on exactly where that will be. I think, we're going to be looking carefully at the incoming data between now and the March meeting and then the May meeting. I don't feel a lot of certainty about where that will be. It could certainly be higher than we're writing down right now. If we come to the view that we need to write down to move rates up beyond what we said in December, we would certainly do that. At the same time, if the data come in the other direction, then we'll make data dependent decisions at coming meetings, of course.
Just as a quick follow-up, how are you viewing the kind of balance of risk between those two options of, the likelihood of maybe falling short of that or going beyond that level?
I guess I would say it this way. I continue to think that it's very difficult to manage the risk of doing too little and finding out in 6 or 12 months that we actually were close but didn't get the job done, and inflation springs back and we have to go back in. And now you really do worry about expectations getting unanchored and that kind of thing. This is a very difficult risk to manage. Whereas, of course, we have no incentive and no desire to over tighten, but if we feel like we've gone too far, we can certainly, and inflation is coming down faster than we expect, then we have tools that would work on that. So I do think that in this situation where we have still the highest inflation in 40 years, the job is not fully done. As I started to mention earlier, we have a sector that represents 56% of the core inflation index where we don't see disinflation yet. So we don't see it. It's not happening yet. Inflation in core services ex housing is still running at 4% on a 6 and 12 month basis. So there's nothing happening there. In the other two sectors representing less than 50%, you actually, I think, now have a story that is credible, that's coming together, although you don't actually see disinflation yet in housing services, but it's in the pipeline, right? So for the third sector, we don't see anything here. So I think it would be very premature to declare victory or to think that we've really got this. We need to see, our goal, of course, is to bring inflation down. And how do we get that done? There are many factors driving inflation in that sector. And they should be coming into play to have inflation, the disinflationary process begin in that sector. But so far, we don't see that. And I think until we do, we see ourselves as having a lot of work left to do.
Howard.
Howard Schneider with Reuters, and thanks as usual. So I just wanted to connect a couple dots here. The statement made a number of changes that seem to be saying things are getting better. You're saying inflation has eased. That's new. You've taken out references to the war in Ukraine as causing price increases. You've taken out references to the pandemic. You've eliminated all the reasons that you said prices were being driven higher. Yet that's not mapping to any change in how you describe policy. We still have ongoing increases to come. So I'm wondering, why is that the case? And does it have more to do with uncertainty around the outlook, or more to do with you not wanting to give a very overeager market a reason to get ahead of itself and overreact?
So I guess I would say it this way. We can now say, I think, for the first time, that the disinflationary process has started. We can see that, and we see it really in goods prices so far. Goods prices is a big sector. This is what we thought would happen since the very beginning, and now here it is actually happening. And for the reasons we thought, it's supply chains, it's shortages, and it's demand revolving back towards services. So this is a good thing. But that's around a quarter of the PCE price index, core PCE price index. So the second sector is housing services, and that's driven by very different things. And we, as I mentioned, with housing services, we expect, and other forecasters expect, that measured inflation will continue moving up for several months, but will then come down, assuming that new leases continue to be soft. And we do assume that. So we think that that's sort of in the pipeline. And we actually see disinflation in the goods sector, and we see it in the pipeline for two sectors that amount to a little less than half. So this is good. And we note that when we say inflation is coming down, that this is good. We expect to see that disinflation process will be seen, we hope soon, in the core goods the core services ex housing sector that I talked about. We don't see it yet. It's 7 or 8 different kinds of services. Not all of them are the same. And, we have a sense of what's going on in each of those different subsections. Probably the biggest part of it, probably 60% of that is research would show is sensitive to slack in the economy. And so the labor market will probably be important. Some of the other ones, the labor market's not going to be important. Many other factors will drive it. In any case, we don't see disinflation in that sector yet. And I think we need to see that. It's the majority of the core PCE index, which is the thing that we think is the best predictor of headline PCE, which is our mandate. So it's not that we're neither optimistic or pessimistic. We're just telling you that we don't see inflation moving down yet in that large sector. I think we will fairly soon, but we don't see it yet. Until we do, I think we see ourselves, we got to be honest with ourselves. We see ourselves as having perhaps more persistent inflation in that sector, which will take longer to get down. And we're just going to have to complete the job. I mean, that's what we're here for.
Nick Timmeros, the Wall Street Journal. Chair Powell, you observed several years ago that we learned we can have a low unemployment rate without above target inflation. And we have learned lately that inflation can come down from its uncomfortably high level despite a historically low unemployment rate. Given that, and given how much you did over the last year, why do you think further rate increases are needed? Why not stop here and see what transpires in the coming months before raising rates again?
So we've raised rates 4.5 percentage points, and we're talking about a couple of more rate hikes to get to that level we think is appropriately restrictive. And why do we think that's probably necessary? We think because inflation is still running very hot. We're, of course, taking into account long and variable lags, and we're thinking about that. The story we're telling about inflation is to ourselves, and the way we understand it is basically the three things that I've just gone through a couple times. And again, we don't see it affecting the services sector ex housing yet. But I mean, I think our assessment is that we're not very far from that level. We don't know that, though. We don't know that. So I think we're living in a world of significant uncertainty. I would look across the spectrum of rates and see that real rates are now positive, right, by an appropriate set of measures are positive across the yield curve. I think policy is restrictive. We're trying to make a fine judgment about how much is restrictive enough. That's all. And we're going to, that's why we're slowing down to 25 basis points. We're going to be carefully watching the economy and watching inflation and watching the progress of the disinflationary process.
Did you or your colleagues discuss the conditions for a pause at this meeting this week?
You'll see the minutes will come out in 3 weeks and we'll give you a lot of detail. We spent a lot of time talking about the path ahead and the state of the economy. And I wouldn't want to start to describe all the details there, but that was the sense of the discussion, was really talking quite a bit about the path forward.
Victoria.
Hi, Chair Powell. I wanted to ask about the debt ceiling. Given that we've now hit up against it, I was wondering if the U.S. goes past the X date, will the Fed do whatever the Treasury directs as it relates to making payments as the fiscal agent, or will it do its own analysis of any legal constraints?
So your question is, would we say your question again?
Will the Fed do what Treasury directs as it relates to making payments, or will it do its own analysis of any legal constraints?
So you're really asking about, you're asking about prioritization in effect, is what
Yes,
you're, okay.
yes.
So I feel like I have to say this. There's only one way forward here, and that is for Congress to raise the debt ceiling so that the United States government can pay all of its obligations when due. And any deviations from that path would be highly risky, and that no one should assume that the Fed can protect the economy from the consequences of failing to act in a timely manner. In terms of our relationship with the Treasury, we are their fiscal agent, and I'm just going to leave it at that.
Are you actively doing any planning of what might happen in the event that would happen?
I'm just going to leave it at that. This is a matter that's to be resolved between it's really Congress's job to raise the debt ceiling, and I gather there are discussions happening, but they don't involve us. We're not involved in those discussions, so we're the fiscal agent.
Gina and then Steve.
Jade Powell.
Gina Smilik from the New York Times. Thanks for taking our questions. I wonder, was there any discussion today of the possibility of pausing rate increases and then restarting them? Lori Logan from the Federal Reserve Bank of Dallas seemed to suggest that would be a possibility in a recent speech. And I wonder if that view is broadly shared on the committee.
So the committee obviously did not see this as a time to pause. We judged that the appropriate thing to do at this meeting was to raise the federal funds rate by 25 basis points. And we said that we continue to anticipate that ongoing increases in the target range will be appropriate in order to attain that stance of sufficiently restrictive monetary policy that will bring inflation down to 2%. So that's the judgment that we made. We're gonna write down new forecasts in March, and we'll certainly be looking at the incoming data as everyone else will.
Sorry, I should have been clear. I mean, would it be possible to take a meeting off, for example, and then resume? Could you, rather than just doing at every meeting a move, go a little bit more slowly, take some gaps in between moves?
I mean, I think this is not something that the committee is thinking about or exploring in any kind of detail. In principle, though, we used to do was go every other meeting, if you remember, 25 basis points, and that was considered a fast pace. So I think a lot of options are available, and you saw what the Bank of Canada did, and they left it that they're willing to raise rates after pausing. But this is not something that the Federal Open Market Committee is on the point of deciding right now.
Steve Leisman, CNBC. Mr. Chairman, the SEP has the PCE inflation rate in 2023 at 3.1%. Meanwhile, the 3-month annualized PCE is 2.1%, and you've achieved this without going to your 5.1% funds rate, which is what you have penciled in for this year. And you've also achieved it without the 1 percentage point increase in the unemployment rate, which you have penciled in for this year. I'm wondering if you've considered the idea of whether or not your understanding of the inflation dynamic may be wrong, and it's possible to achieve these things without raising rates that high, and also without the surge in unemployment. And specifically, I wonder if you might comment on the speech given by Vice Chair Lael Brainerd, who said, to the extent that inputs other than wages may have been responsible in part for important price increases for some non-housing services, an unwinding of these factors. In other words, it may not be wages the idea that it may not require unemployment rising to get this sector of inflation under control? Thanks.
So a couple things. First, on the forecast, if you're right, if you take very short-term, three month say measures of PCE, core PCE inflation, they're quite low right now. But that's because that's driven by significantly negative readings from goods inflation. Most forecasters would think that the significantly negative readings will be transitory, and that goods inflation will move up fairly soon back up to its longer run trend of something around zero, something like that. So a lot of forecasts would call for core PCE to go back up to 4% by the middle of the year, for example. So that's really where the sustainable level is more like at 4%. So that would suggest there's work left to do. Let's say inflation does come down much faster than we expect, which is possible. As I mentioned, obviously our policy is data dependent. We would take that into account. In terms of the core non-housing services, as I mentioned earlier, it's a very diverse sector, 6 or 7 sectors, and so sectors that represent 55 or 60% of that subsectors of that sector we think are sensitive to slack in the economy, sensitive to the labor market in a way. But some of the other sectors are not. And for example, financial services is a big sector that's really not driven by labor markets, wages. So that's why I said there are a number of things that will affect. Take restaurants, right? So clearly labor is important for restaurants, but so are food prices. And transportation services is going to be driven by fuel prices, for example. So there are lots of things in that mix that will drive inflation. I would say overall, though, my own view would be that you're not going to have a sustainable return to 2% inflation in that sector without a better balance in the labor market. And I don't know what that will require in terms of increased unemployment, your question. I do think there are a number of dimensions through which the labor market can soften. And so far, we've got, as I mentioned, in goods, we have inflation moving down without the softening in the labor market. I think most forecasters would say that unemployment will probably rise a bit from here, but I continue to think that there's a path to getting inflation back down to 2% without a really significant economic decline or a significant increase in unemployment. Good. And that's because the setting we're in is quite different. The inflation that we originally got was very much a collision between very strong demand and hard supply constraints, not something that you really have seen in prior business cycles. And so now we see goods inflation coming down for the reasons we thought, and we understand why housing inflation will come down. And I think a story will emerge on the non-housing services sector soon enough. But I think there's ongoing disinflation, and we don't yet see weakening in the labor market. So we'll have to see.
Can we get there with 5%?
Certainly possible. Yeah, absolutely, it's possible. It's a question no one really knows. I think it's because this is not like the other business cycles in so many ways. It may well be that that it will take more slowing than I expect to get inflation down to 2%. But I don't. That's not my base case. My base case is that the economy can return to 2% inflation without a really significant downturn or a really big increase in unemployment. I think that's a possible outcome. I think many forecasters would say it's not the most likely outcome, but I would say there's a chance of it.
Michael.
Michael McKee from Bloomberg TV and Radio. I'd like to pick up on what you were just saying about a substantial downturn and ask, with the full weight of your tightening not in place yet, and with the progress against inflation, there's still a lot of talk about very, very slow growth going forward in 2023. And the recession indicators are all suggesting that we are going to see recession this year. So I'm wondering if you've changed your view, or you have a more nuanced view of what you think the danger to economic growth is going forward, and whether you're very close to perhaps tipping it into the wrong place, which calls for more restraint on your part.
So I do think most forecasts and my own assessment would be that growth will continue, positive growth will continue, but at a subdued pace, as it did last year. We had growth of GDP growth of 1% last year, and also final sales growth, which we think is a better indicator of about 1%. I think most forecasts and certainly my assessment would be that growth will continue at a fairly subdued level this year. There are other factors, though, that need to be considered. You will have seen that the global picture is improving a bit, and that will matter for us potentially. The labor market remains very, very strong, and that's job creation, that's wages. As inflation does come down, sentiment will improve. You also, state and local governments are really flush these days with money, and many of them are considering tax cuts or even sending checks. So I think that's going to support. They're also spending a lot. There's a lot of spending coming in the construction pipeline, both private and public, and so that's going to support economic activity. So I think there's a good chance that those factors will help support positive growth this year. And that's my base case is that there will be positive growth this year.
Rich?
Thank you. Rich Miller from Bloomberg. First of all, how are you doing?
Fine, thanks. Fine.
Good. Second off, I think earlier on in the press conference, you said you need to see substantially more evidence of inflation coming down. Can you give us some idea of what you're thinking of? You mentioned 3 months, that we've seen 3 months in a row. Governor Waters suggested he might want to see 6 months. Is it just the inflation data, or do you have to see the labor market coming back into better balance to have that substantially more evidence?
So I don't think there's going to be a light switch flipped or anything like that. I think it's just an accumulation of evidence. So, of course, we'll be looking, by the time of the March meeting, we'll have 2 more employment reports, 2 more CPI reports, and we'll be looking at those carefully, as all of us will, and we'll be asking ourselves, what are they telling us? And soon after that, we'll have another ECI wage report, which, as you know, is a report that we like.
Yeah, I think we pretty much got it, huh? Sorry, I was writing another J Powell comment in the.
Yeah, so that was fun. that was awesome. So, all right, here you go. Here's the fun fact. Everybody write a great J Powell comment. We've had some great ones coming from Jonathan Ramirez and Zach. Jonathan, I think you even had 1 or 2. So everybody write a great J Powell comment like we were seeing, and we'll exit the stage left here. So, Zach, what are you thinking that you're hearing? I heard 2 more interest rate hikes. That definitely came across.
It's probably smaller, 25 basis points.
And you know what? He seemed to be fairly dovish, which I think is just call it bullish. But anyway, he seemed to be fairly bullish. He didn't say the word data 8 million times. I don't know. I got a better feel. What do you think?
I agree. I think it's more clarity than I thought we'd get, as long as he stays true to kind of what's going to transpire here. But it feels like a couple more 25 basis points. That's exactly what I heard.
Jonathan, what you thinking?
I'm excited. I put in the chat, I think the Bulls are about to run wild. We can already see that with Bone. That was the last little thing that we needed to see here before people kind of get locked and loaded. So I'm very bullish.
Yeah. So here's what we know, right? We know 25 basis points a day. We know we get a CPI report coming out of February 14th. We know we've got a jobs report coming out somewhere in there as well. We're also going to get the minutes of the last Fed meeting, which will be about 3 weeks from now. So we got a lot of data points coming. And then we roll into a March meeting. Sounds like in the March meeting, we should expect a 25 basis points raise. I've been saying in my videos, and I want your guys' opinion, that today was going to set the tone for really February and March. Outside of those reports and some of those things I just mentioned, Zach, you go first. What do you think? I'm on track here? Do you think this is kind of setting the tone? What's your 2 cents?
I agree. I mean, there's no real reason we should see a mass sell-off. And I mean, I think what would have caused it would have been some outlier today, or something that, we're going to be raising interest rates 25 basis points and expect higher rates to come, or something of that. I didn't hear that. I don't feel that. And I agree. I think the tone was positive. There's no reason, I think, that we should give a lot of this back. I mean, maybe, sure, there's going to be some red days, in the market. It goes up and down, but I don't see it going back, to 16K where we were before the start of the year. Not right now, at least. It feels like we're in a pretty good spot right now.
Jonathan, go ahead.
Looking at all this, first of all, thank you everyone who stayed on the channel for watching that paint dry. I'm sorry that we did that, but that's what we're doing today. But either way, look, y'all, the first time you had me on in the very beginning of the year, talking about the new year and kicking it off with a bang, all of us are ready. We've all added a lot, and we've kind of just been incrementally adding and watching what happens. But now we know we got a good 30 to 45 days of uphill run. So I hate to keep saying bullish, man, but I am bullish, and I'm just excited that we're going to get to see what's going to happen here. There's nothing going to suppress our good news as it rolls out.
Yep.
Yeah, I think today was a big hurdle. So now we're going to cut to, I got to go back up here. I want to see some of these comments. Let's see. Hold on just a minute. So I asked you guys for some of your favorite JPAL comments, because we had some good ones coming. Hold on. Let's see. I got to go, man, I got to go up here a little bit. Okay, so we're going to start with Foxy, because Foxy's always, so Powell's no lips from sucking the life out of the market. All right. Let's see here. So Powell said, get your Speedos ready. There's Boca. I heard Powell challenge Chuck Norris to a sparring match, and he declined. Okay. Nice. Powell once pissed in the gas tank of a semi-truck. That semi-truck is known as Optimus Prime. Okay. What is this? He looked like the teacher off Michael Jackson's music videos. That's funny. I have to go look at that. Doppelganger from Mr. Mackey from South Park.
Mr. Mackey. That's
Mr.
hilarious.
Mackey. Let's see. Oh, here we go. Powell walks around YMCA trying to talk to everyone. Oh my God. That's not
he's
right.
The guy. He's the guy sitting in the sauna, like naked, like it's normal.
Yeah. Yeah.
Nothing weird here. Nothing
weird here. Nothing to look at. Nothing to look at. Powell was with Ozzy when he pissed on the Alamo. Okay.
People are creative. I love it.
He's an undercover. There you go, Jonathan. He's an undercover Shibwell. There you go.
Probably.
How about his jab at Congress a little bit?
Yeah. Ooh.
That was interesting, wasn't it?
That was a little shot across the bow, man. They don't invite us to the meetings.
Like, that's not my job. Like,
they got to raise the debt ceiling.
Figure that out over there.
I was like, okay. Hold on just a minute. Oh, here we go. Rumor has it Powell started a new game called Data Pong. Whoever can say data at the end of the sentence doesn't have to drink. I was wondering if that's where you were going, Zach, earlier. You were like, data, drink, data, drink.
Right. Yeah, he had a little stretch there where he said it like 3 or 4 times, but that was it was pretty tamed.
That's funny. All right, here we go. Oh, here we go. Powell's the guy who eats oatmeal after a walk to the dumpster workout. Thank you, Cisco. Appreciate it. Let's see. Hold on.
Foxy said Powell makes eye contact at the urinal.
Yeah, you don't make eye contact. You're like heads down. Yeah.
And you always skip a urinal if there's one there.
Absolutely. You move over.
Always skip one. If it's the last one, you really got to pee. All right, it's okay. But
so what's funny? I have my son's 14, right? So we went into a couple of years ago. We went into a public bathroom, and I moved over one, and there was one on the other side of me, and I told my son, I said, move over here on the side of me. And he's like, why, Dad? Why? Is there something wrong with this guy? And the guy started laughing. He was
he's trying to figure it out.
He was good enough at sport about it, right? I'm like, just move over.
Yeah, it's just how it's played.
It's just how it's played, man. All right. Let's see. I think we get a point here. Let's see. All right. So, all right, let's take it home here, guys. Final thoughts. So Jonathan, we're going to go around the horn. We're going to end this. We've been here about an hour and 10. We got everything we need. So what's your final thoughts, Jonathan?
So my final thoughts, everyone that does not know, Austin, Zach, always putting out information about Shiba Inu. And I know I keep going back to them today, but look, this is the month of Shiba Inu. This is the month of Leash. This is the month of Bone. Please take a look at those. Also Clear Cryptos. stay bullish, enjoy the ride. We never tell you what to buy, but we're telling you that things are looking pretty good, at least in my opinion. I love y'all, and thank you for being here with me.
Cool.
100%. 100%. Yeah. And, it was a pretty good day. Honestly, I think this is a win for everybody in crypto and really for anybody in the markets. I think the stock market was bouncing too, wasn't it, Austin?
Yeah, it was all over the place, but we're coming back. Crypto's now up 0.71. Stocks kind of, the NASDAQ's on fire, but Dow's down. Oh, there we go. Look, NASDAQ now, the Dow just took off. So
I think that's exactly what you said earlier, Austin. It's a little bit of clarity to what's to come. We finally got a little bit of clarity in terms of what we can expect. And he said, I think I tweeted the quote. What did he say? Hold on, let me find the tweet. Hold on, because I took it word for word there. Powell said a couple more rate hikes to get it down where it needs to be. A couple more rate hikes to get it down to where it needs to be. So 25 today, the expectation is probably a couple 25 basis point moves, and who knows?
There we go.
But it's good. Well, it's good. Positive.
That was a good day. So I'm going to give Jonathan a shout out. Thank you, Jonathan, for spending some time, man. This is Jonathan's channel. Go give him a subscribe. Great content. Always there for you. As everybody knows, Zach, one of my good buddies, obviously his content is his channel. Links in the description below as well. So looking good there. Hey, what's going on with Shibarium? Oh, I don't know. Not a lot. No, kidding. It's go watch Zach's Shibarium video. Oh, I'm on there. Wow, that's cool. Okay. All right.
Yep. You got one coming out later too. Right?
I got one coming out later. So yeah, my final thoughts, all I can say is that I'm considering today a win. He could have derailed a lot today, and he didn't say data every other word. He gave us some clarity and some visibility. The market's reacting. I think this is as close as you're going to get to dovish, bullish with Powell. And I think it's a good thing. So we're going to end on that note. So with that said, guys, thank you for spending some time. Catch us on the replay. As always, we'll be here, and hit that subscribe button, hit the like button on your way out. We'll see you. Have a good one. Take care.
Jay Powell.
Papa Powell.